5 ways to get smart about your loans. That's what we're going to talk about today. Everybody takes loans because we have a need, we have an asset we want to buy, whatever it is. But after you take that loan, do you revisit it? Do you analyze it? And that's where we're going to talk about a couple of tips that one needs to do so that you're smarter with your money. Remember, every penny saved is a penny earned. That's how we need to look at it. So the first thing which I want to talk about is what I see many people do today is margin trading. What is margin trading? You put in say 15 or 20% of the money up front and the broker will support you to buy 100% value of that portfolio or stock or whichever it is and allow you to benefit from the appreciation or depreciation of that portfolio. Now this loan, because the stock is fundamentally held by the broker, comes at a rate of about 10 to 12% interest rate. But essentially you're buying because you're looking at a short-term profit to happen. Exceptionally risky and extremely dicey. I've had cases where people who were trading on these high-frequency transactions after a period of time discovered that there was no margin left. Their 15 or 20% had disappeared and become zero. In fact, it's told that 98% of all those people who trade in the stock markets don't make money, end up losing money. So margin trading is one such loan that I urge you to explore carefully and don't get in if it's not your cup of tea. Second, ever looked at your credit card statement? The credit card statement, if you look deeply, will show you the amount that you owe the credit card company for usage during the past, say 30 days. But it will also show you the amount you need to pay is a much smaller amount. Say if your credit card usage was say 15,000 rupees in the past month, it will say it's enough if you pay 1,250 rupees. Now many people think it's a smart thing to just pay 1,250 and then use that credit for a longer period. Unfortunately, it's the most wealth destructing thing you can ever do. And I mean it. Because the cost of credit card loan is the highest that you will ever find anywhere. I believe the company that I bank with had at some point in time the credit card loan amount at 42% per annum. That is 3.5% every month. So if you spend 15,000 and you paid 1,250, then the balance of amount, which is 13,750, will attract 3.5% over the next 30 days. And that will carry on till you have paid the entire amount, which is quite phenomenally a large number. We don't make that kind of returns even in the stock market. So it's the single most wealth destructing thing that I would urge you to look carefully. So if you ever use your credit card, make sure on the due date you pay back the amount fully without leaving any balance. I'd urge you, I'm sure this will make you fundamentally a much better person managing your personal money. Third, I'm going to talk about the concept of flat rate. Recently, a client of mine called and he said, Babu, you know what? I got this call. My banker is willing to give me a flat rate overdraft of 10 lakhs at just a rate of 9%. I said, wow, sounds good. 9% is still a very, very good rate for an asset-free loan. He's not taking a housing loan. There is no asset backing. There's no security. Security-less loan at 9% got me thinking. So I asked the person to find out more details. He said the banker told him it's a flat rate 9%, which is offered for 3 years. And there I got the answer. A flat 9% is very different from a 9% on a reducing balance basis. A 9% on a reducing balance basis is actually the 9%. A flat 9% means that on the overall tenure of the loan for 3 years, you have to pay 9%, whereas your EMIs will start from the next month onwards, so your balances will keep reducing. So effective rate on a 3-year 9% loan is actually 16%. In the case of this gentleman, the transaction fee for this was 1%. So that further adds, which means the transaction fee is upfront collected. So on a 10 lakh portfolio, 10,000 rupees is collected upfront. So he only gets 9,90,000. And therefore, there is a further amount that he needs to pay. So the interest goes up still further. Plus, he was told that you need to pay 2 installments initially upfront. Now, all this meant that the cost of his loan was upwards of 20%, while this investor was thinking that he had a cheap loan at 9%. You need to be very, very careful and cautious about looking at loans of this nature. Fourth, housing loan interest rates have been going up quite steeply. And we know that most people, most banks haven't come back and changed EMIs. Now, therein lies the devil in the detail. Any housing loan has a factor in which if the interest rates is going up, the EMI has to move up in tandem. If the EMI hasn't moved up, then the tenure of loan has automatically changed back in. Only you didn't know it. Extremely important. It's important in times like these to go back and check with your banker what is your current tenure of the loan. And I'm sure if your EMI hasn't got adjusted higher, your tenure of your loan has been pushed by another 2 or 3 years more. You may be thinking that your loan gets over in the next 5 or 7 years. It's actually moved up by 3 more years. So from a 7-year period, it's moved to 10 years. It's entirely possible. So do check that. But if you're one of those smarter guys who's allowed your EMI to go up in tandem with that, your period has not changed. Your period has remained where it is. This is one more way in which people don't make smart with their money. All people who are salaried usually get a 5 to 10% hike every year. Now, if your EMI is also increased every year, you go back to your banker and say, hey, I started with a 50,000 EMI. At the end of 12 months, I got a salary hike. The EMI can go up by another 5%, right? So, or 10%. If on a 20-year loan, your EMI goes up by 10% every year, your entire loan will be paid up in 10 years. You will save 10 years of your loan payment. Believe me, that's huge. Only thing, you must have a discipline that every year you go back because your salaries have already gone up and your needs have necessarily not changed. So you do have that surplus. You need to be smart about using this. Last but not the least, I was talking to an investor and I saw that he had taken life insurance newly and he also had taken some health insurance. And I was checking with him, why would he want to take? Because I thought he had been reasonably well covered already. He said, no, Babu, it is part of my loan documentation. The loan that he took, the banker said the loan needs to get covered by a life insurance and further with a health insurance as well. Now, while the loan itself was only costing him 9%, these additional unwanted insurance risks, when you compute together, increased his cost of loans and borrowing substantially. I asked him, did he check with the other banks, other institutions, which could offer him the same rate without bundling these insurance opportunities? He didn't have an answer. Many a times, we take it for granted that the banks need you to take an insurance along with the home loan. Not necessarily. If you already have sufficient insurance, both life and health, you can show that to your banker and say you are sufficiently covered. All you are looking for is a loan. That is good enough. You don't need to buy. Sometimes bankers bundle these products because they need to do what they need to do. You would be smart to recognize this and separate the two. If loan is what you want, take that separately. The insurances, if you are adequately covered already, you don't need to bother about it. I think these are 5 aspects of how one manages loan, and I'm sure if you manage it smartly, you would benefit tremendously in time.